interesting time. As you see, we are in the Future Hospitality Summit. And if you look at the 10-year, 5-year, 10-year pipeline of GCC MENA as a whole, we are looking at anything between $2 to $2.5 trillion of investments that are needed. And this is the point of conversation with my panel. I'm Amit Nayak. Let me welcome my panel. Khatija, Olivier, Kapil, Camil. Come, please. Hi. So let's start by introducing yourself, talking about the business in general. And one of the key touch points that I would like to focus on is what is your sentiment of the hospitality market in MENA, and is it positive? Khatija.
Okay, I'll start. My name is Khatija Haque. I'm the Chief Economist and Head of Research at Emirates NBD in Dubai. We do focus a lot on travel and tourism. Obviously, it's a big driver of Dubai's economy. So what we've seen is that the region, the Middle East region, has more than recovered from the disruptions of the pandemic. It's probably the only region that has actually exceeded pre-pandemic levels in terms of international visitor numbers. Europe is almost there, and Asia's kind of the laggard at about just over 50% of where they were before the lockdowns. But we are optimistic over the medium term. Everybody's been talking a lot about the huge amount of investment that's going to be going on in Saudi Arabia, but we've also got investment in other GCC countries, including the UAE. So we're quite optimistic over the sector, or over the medium term rather, for the sector.
Okay. Olivier.
Thank you. I'm Olivier Granet, Managing Partner and the CEO of Kasada Capital Management. Very pleased to be here, and thank you for the opportunity to share our experience as investor and financing project in Africa. So we focus on the African market. We are the leading investment platform in sub-Saharan Africa, and our ambition is to expand and become a truly Pan-African investor. So I hope that we'll have also the opportunity to bring more interest, and for some of the investor, bankers, and operators present in the room to get more traction for the African market, where there is a growth and a lot of opportunities.
Thank you, Olivier. Kapil?
Hi, Kapil, Jobanputra, Standard Chartered Bank, part of the global real estate business, which includes hospitality, responsible for Middle East and Africa, as well as sponsors activity globally, so capital flowing out of the region and capital flowing into the region. I think, Amit, just to touch upon the point you mentioned, globally, real estate, hospitality is somewhat of a hot topic at the moment. We're seeing a lot of, I would say, in some markets, some stress, but definitely some dislocation across other markets because of interest rates and because of generally the trend of what's happening in the office market, hospitality market, retail, and e-commerce, work from home, and so on. The Middle East has been certainly an outperformer versus other markets. We're seeing post-COVID a shift and a reset in what's happening across the Middle East, across asset classes. And it certainly is a growth market which seems to be bucking the trend, notwithstanding where interest rates are. And so I think that's an interesting topic to get onto in due course. But no, very optimistic about the outlook for the region.
Yeah, come in.
Hello, everyone. Can they hear me?
No, the mic.
Can you hear? Yeah. Okay. Hi, everyone. So Camil Yazbeck. I'm Global Chief Development Officer for Accor, mostly focusing on premium, so upper upscale, midscale, and economy brands. They can't hear. Okay, now we can hear. So I'm going to say it again, sorry. Camil Yazbeck, Global Chief Development Officer for Accor, mostly focusing within the division of the premium, midscale, and economy. Towards your question, for the Middle East region in particular, I've seen very robust economies. I've seen governments really supporting the investments. RevPARs are very, very strong. So overall, it is a key region for us, and we can see a lot of potential and growth in this region in particular. And going back to your point with regards to asset classes, I can see globally, and I've been just recently in Japan and Seoul just last week, and I can see that the focus of hotels from investors as a real estate asset class is much higher than before. So when you invest in office or logistics or student resi or whatever, the focus right now is mostly on hotels, which is great for us, especially in this conference.
Thanks. So to the two bankers, with the rising interest rates, inflation and everything else, so from a macro lending environment within the region and even globally, how are you seeing that as an impact in the market? And as well, do you see hospitality with the amazing RevPAR numbers and all that Camil was talking about? We are all aware about it. It is not easy to do a staycation in Dubai or anywhere else as of now, because you're paying more or less as much, if not more, than what you pay in Europe now. So is that a hedge from a business case environment?
So from the macro perspective, I can give you our views on rates going forward, and then we can talk a little bit about the impact on demand as well. We've seen the most aggressive tightening in monetary policy, certainly over the last 30 or 40 years, but I would argue ever. It's not just been the scale of the tightening, but the speed with which it has happened that's really been unprecedented. And I think everybody is still kind of adjusting a little bit to that reality. The Fed last week was still pretty hawkish, so even if they are done with raising rates, or close to done with raising rates, we don't think that rates are going to be falling anytime soon. So we're expecting only an easing from, say, the middle of next year. Obviously, that's on the assumption that the economies slow gradually and we have a soft landing, I guess. So clearly, that's going to have a big impact on feasibility for investment, right? And if you're borrowing from a bank, those costs are now prohibitive. So you really need a high internal rate of return in order to justify going to borrow from a bank to fund that investment. We are seeing, or there are indications that you can get long-term funding perhaps at a cheaper cost by issuing bonds. So that's one option. Yeah. But this is, I think, an issue that people are going to have to live with to some extent, because again, we don't see a return to 0 to 2% rates in the near future. I mean, at best case scenario, you're looking at a neutral level of around 2.5% to 3% on dollar rates going forward. So that is, I think, a structural change from what we've seen over the last 20 years or so. On the demand side, you know, consumers have been benefiting from wealth effects. Housing costs, or you know, equity in homes has gone up. Financial markets have done really well. They've had pandemic savings, and that's been able to sustain consumption even as rates have gone up. But I think we're now getting to the point where we're starting to see consumers under pressure, and we're starting to see evidence that they're cutting back on discretionary spending, including travel. So I think 2024 is going to be perhaps a little bit more challenging from that perspective. Demand is probably not going to grow as quickly as it has over the last 2 years coming out of the pandemic. And on the issue of the dollar, I mean, for our region, this is key, because we're all pegged to the dollar, and we're in a period of sustained dollar strength. So when you've got the majority of your visitors coming from emerging markets, whether it's the subcontinent or Asia, it's becoming less and less affordable to come to this region. So I think it becomes more important for businesses in that sector to offer value for what they are charging, to make it a more attractive place to go relative to Europe, for example.
Fair enough. Kapil, on this note, so how are you looking at our business of real estate as hospitality as a hedge? Do you see it that way?
As a hedge to...
To the inflation and everything else in other businesses that are very common.
Yeah, look, I think just to touch upon a couple of those points, I think there's a lot of talk around high interest rates and it's prohibitive and it doesn't make sense anymore. I think that has to be looked at in a certain context. We've been in a very unusual period for the last 10 years, and actually 0, 1, 2% interest rates is not normal. The normal is having a base rate of 5-odd%. So I think there is going to be a reset. People need to go back to the table and look at what IRR justifies the cost of funding. And banks, funders need to think innovatively around funding structures and how that works. And I think just on the point around on viability, the ultimate truth is that whilst private equity has been largely debt funded over the years, whilst developers, asset owners have looked to use increased levels of debt, which has made sense, the reality is that more equity needs to come into projects. And that equity needs to be seen as a more substantial part of project funding, whereas debt cannot be the majority of that anymore. It needs to come to the right balance of the right capital structure, which makes projects viable, both from a development perspective, but also from an income-generating perspective.
On that note, Olivier, in Africa, where majority of your business is based on, what kind of financial structures do you look at? How does it work? Because I'm sure there, compared to GCC, there's a big difference in the way it works.
I would just like to highlight one paradox. It's quite interesting because you said, you are very right, that it's unprecedented regarding what is happening on the interest rate. However, the question for us as investors is, what do we learn and how do we adjust? And you say adjust a little, and we mentioned about new project and higher IR, but in fact, the reality is the wait and see attitude to say that let's hope that interest rates will go down in the coming month and next 2 years. Hopefully it will be the case, but if not, what are we doing? How we create some new room to maneuver? And I just had example on one of our projects where we work more than a year with a bank to structure the financing, and just before signing, and it was last month, we said, yeah, but the covenants, how are we realistic on the impact? How we take into consideration the environment? And it's also true for the inflation on operating cost. And we said that, no, it's too tight, and there is no reason between investor and bankers to enter in a transaction where there is high probability to face some issue with covenants. So we need to create this maneuver, which means also that for us in Africa, the way we operate, and you were raising some example in UAE in terms of financing, is very different. Our initial target was to be 50-50 between debt and equity. And in fact, with what is happening on the market, it's more for us, the blended is 37-38% debt, because we need to create and we need to ensure that we have a healthy portfolio and we can absorb what is happening on the market. Just to comment on the demand, I believe it was very important to have a phase for recovery. In post-COVID, to see the rates that sometimes nobody was expecting, it was important for the business. Important to generate again cash flow, important to invest in people, important to invest in product. Probably we are reaching now a point where the question is about how is it sustainable when we see sometimes the rates that we have, and probably to come back about the value creation, the positioning on the market, what we offer for the guest, to take a long-term perspective. So it was really needed, and now probably we need to enter a new phase to ensure that we have the right approach for each property. I believe that this is our collective responsibility if we want to make it sustainable.
Thank you. Thank you, Olivier. Camil, from a global perspective, as the CDO, you work in different markets, and I would assume your key job is relationship management. Now, when you're going into development, what are you seeing the difference in MENA versus other parts of the world where things are more mature from a growth point of view. The region has the highest growth in GDP of 4.1%. And I hope and I see that as we move forward in the coming years, it will sustain and grow further.
Sure. I think we need to take a step back for just to say that what is happening today in the markets was like this in the 80s and 90s, beginning of 90s. Private equity firms, when they started, they were promising investors much higher IRRs and returns because the interest rates were very high. So the key point now is how you structure a deal, whether it all depends on the kind of owner. What is their cost of capital? What is their investment criteria? And this is key for us to understand when we develop. It's not only purely the relationship, it's to make sure that our offers and how we marry the deal is with the right owner, with the right type of owner, and to make sure that they're going to be successful. So if they succeed, we will succeed. It's a little bit of cliche, but it is reality. It all depends. So we've seen a lot of shift of capital from the US to Europe because of debt, because the debt is 200 bips above SOFR. But in the US, it's 400 to 500 bips, which is crazy. So a lot of capital is moving into this region, Southeast Asia, Saudi, of course. So the key point is the type of owners here could be ultra high net worth, could be family offices, could be more on the core side of things. So they want a return of 4%, whether they want a return of 6%. And this is the key. So to answer, that was the long answer. The short answer is our key advantage within Accor and how we develop and build relationships is to think like an owner. And that is key for a future partnership and successful partnership.
Thank you, Camil. Kapil, so as FDI goes, in 2022, the region attracted 70 billion. And the number that is needed for the next 10 years is anything between 1.5 to 2.5 trillion. So there's a big gap. What are the sources of alternative capital that we can encourage to come into the region from an investment perspective to get those healthy IRR and actually to develop all this real estate that needs to be built?
Yeah, so I think it's a really important point. And the market in the Middle East is very different in terms of funding compared to other parts of the world. What we are seeing here is actually there is the equity and the debt sits within the region, but it's very specific to certain sponsors. So from a debt perspective, if you're a government-related entity, a high-quality family office, high-quality sponsor that has a broader business space, you're a much easier place to attract reasonable priced debt capital. And then when you go one level down, and you're looking at development finance for an individual that owns a prime piece of land, but doesn't have that broader balance sheet to provide recourse around, very difficult. So I think lenders do need to think a little bit more methodically around how best to finance project level without that broader recourse, which offsets the real estate risk. The fact of the matter is that in any development project, there is always cost overrun risk, completion delay risk, and that's a risk which banks aren't willing to take as lenders. In particular, in some Western markets, in a doomsday scenario, you can take the land, you can sell the land, you can repay the debt. Whereas in this market where there's less willing buyers and sellers, it's harder to go and repay that debt in an enforcement type situation. So I think just one other point to make is outside of the banks, so both local banks and international banks, I think there is absolutely a requirement for more non-bank lending, so more private capital, whether that's in the form of private debt or insurance companies or pension funds that are able to deploy capital into debt scenarios to consider coming into the market and looking at opportunities.
And to your point also, we are seeing this more and more in the region where not as many as we would like, but there is quite a few of the Brookfields and all coming into the market, supporting different real estate structures and developing hospitality real estates, but also commercial real estates and all within the region. I think one of the key aspects, and I'm conscious of time as well, is when the next disruption comes in, we had COVID, we had all the crises across, the next disruption comes in, how does financing within our business work? So how do you look at the next change, or how should we change our thought process from an investor perspective? Khatija?
I mean, look, if we could predict the next crisis, it wouldn't be a black swan, right? So, I mean, I suppose one benefit of what we've seen over the last several years with the crisis and everything else has been a strengthening of balance sheets, right? So both at the corporate level and also at the household level. When interest rates were low, a lot of companies and investors came in and refinanced long term for 20, 30 years at close to zero. So, they're able to kind of withstand periods of higher interest rates. I mean, one would expect that if there is another global catastrophe, that would ultimately lead to a recession and inflation coming down again, which would allow rates to fall. So I think there are some stabilizers built into the way the system works. Hopefully we won't be in a situation where we have a recession and very high interest rates.
Fair point. Camil?
I think for the future, the key point is to make sure you are global as a company, but also local. So for the financing of the future, we've seen and we are seeing much more conversions, and with our we are set to be very, very successful with that, because with the conversion brands, whether it's mid-scale or upper upscale or whatever, key point is it's an existing hotel, much more sustainable and ESG friendly when you convert rather than build from ground up. And the key point is when we convert a hotel or we build a hotel, we do it for the local population. If you do it for the local population, then the international traveler will come and stay with you.
Anyway.
And just to add, when we look at what we call the augmented hospitality, so we add the F&B, the extended stay to diversify the risk for the investor, the branded residential, wellness, etc., all of it together amalgamated will compress the cap rate for the investor, improve their returns, whether it's for exit or refinancing. And that is key, and we've seen a lot of the banks and lenders love that idea because you're diversifying the risk within that building or that mixed use, plus some retail or other.
Olivier?
Yeah, this is a challenging environment, no doubt about it. However, as I like to end on a positive note and always prefer to look at the glass half full, I believe that if you take one step back, there was a huge gap in terms of term and condition and financing in Africa versus the rest of the world. Now the life is becoming more difficult for everybody, which means that in Africa, it might be counterintuitive, but with regional banks, with DFIs, the capacity to access to financing is better now than pre-COVID. So there are some opportunities, and you need to have your balance sheet and be ready for some challenges. But if you do it right, that represents, I'm convinced, some good opportunities.
I think the GCC market and the MENA market as a whole is going to grow. You are looking at anything between 350 to 500,000 keys currently in the market. You are seeing another 150 to 200,000 keys currently being developed. It's not that they're getting signed, they're currently in development. And the population base, GDP, everything is on a high. So I'm sure if anything comes up, this region is more sustainable than many others. And I think on that positive note, thank you. We had an amazing panel. Thank you, guys. Thank you.